So good afternoon, everyone. My name is Maurya Hanspal, and in this session, we'll continue our previous sessions on understanding capital structure theories. So in the previous session, we tried to understand about your net income approach. Yeah, we talked about the net income approach, and we tried to understand the basic assumptions of the net income approach, and we did like one small numerical on that as well. So in this session, I would be talking about the net operating income approach. So let's write down the topic for today that we have the session for, again, capital structure theories. See, I'm trying to make you understand all these theories in very detail so that you have no doubts. And that is why we took like one 30-minute session for understanding the net income approach only. Okay. So in this session, we're going to talk about the net operating income approach. So basically, do not get confused between these two approaches. The first one was just the net income approach. This one is the net operating income approach. You have this operating extra here. Okay. People tend to uh, like synonymize both of these approaches as the same because they sound same. Because net income and net operating income is one and the same thing, but there is a differences like between these two approaches, and that you need to understand. So net income approach is separate, and the net operating income approach is again separate. Okay. So what do we talk about in the net income approach? Net operating income approach, sorry. Okay. So what it is basically saying, in the previous approach, we talked about the capital structure. Okay. That the value of the firm or the weighted average cost of capital is ultimately like dependent upon the capital structure. Okay. But this theory says it's not dependent upon it. It's ultimately dependent upon the earnings of the firm. Market value of the firm depends upon the operating profit or the EBIT. And in the previous theory, we learned that the market value of the firm depends upon your capital structure, but the market value of the firm has simply mean the value of the firm. The value of the firm is affected by the capital structure. उसमें कितना debt है, कितना equity है. In the net income approach. But in the net operating income approach, it basically means your market value of the firm or simply the value of the firm is not affected by the capital structure. It's ultimately affected by your EBIT or the earnings of the firm. कि firm में कितना profit है, firm की कितनी income है, उसके basis पे the value of the firm would be depicted. So let's go back to the assumptions and try to read the theory behind that. So it says the net operating income approach is opposite to the net income approach. This is also known as independent hypothesis approach. Just remember this word. It's also asked in the questions in BBA, BCom, and MBA examination. Explain the independent hypothesis approach. And then people tend to confuse कि net income approach है, net operating income approach है, या बाकी दो approaches है. Okay. So according to the net income approach, the market value of the firm depends upon the net operating profit or the EBIT and the overall cost of capital or the WACC. Market value of the firm depends upon the net operating EBIT and the overall cost of capital WACC. Means capital structure has no role to play in it. It just depends upon the EBIT and your WACC, the weighted average cost of capital, the capital structure. It says the financing mix or the capital structure is irrelevant and does not affect the value of the firm. But the financing mix they mean ultimately the capital structure of the firm. कितना equity है, कितना debt है. Okay. The net operating income approach makes the following assumptions. The investors see the firm as a whole and this capitalizes the total earnings of the firm to find the value of the firm as a whole. The investors are viewing the firm as a whole and thus capitalizes the total earnings of the firm to find the value of the firm as a whole. So ultimately, it is not just seeing the debt and the equity component of the firm. It is viewing the firm as a whole on the basis of its earnings also, and on the basis of its profitability or total earnings of the firm, I mean EBIT, which is attributable to both the equity holders and debt holders. So it takes into view the whole company by taking into consideration the earnings of the firm and then calculates the value of the firm. Okay. The second assumption, it says the overall cost of capital, which is depicted by KGO of the firm, is constant and depends upon the business risk, which is also assumed to be unchanged. It says the overall cost of capital is constant. Like no matter company में कितना debt हो, कितना equity हो, the overall cost of capital will always remain constant. But in the real life, we can see when the debt increases, the WACC also increases, because WACC has a component of the cost of debt also. Cost of debt and cost of equity होता है WACC में. अब जब डेट बढ़ जाएगा कंपनी में, तो कॉस्ट ऑफ डेट भी तो बढ़ जाएगा. And ultimately, when the cost of debt will increase, the overall cost of capital or the WACC will also increase. But since this approach is ignoring the impact of the capital structure, that's why it has assumed that the overall cost of capital is constant. And on the basis of that, it has also assumed that the business risk of the firm is constant. Why the business risk of the firm is constant? Because ultimately जब firm में debt ही नहीं है, तो risk किस बात का, right? Because why your weighted average cost of capital or the WACC increases? When the cost of debt increases, the firm is taking like more and more debt. So in that case, when the firm becomes more risky and the business risk of the firm also increases, right? Business risk and financial risk both basically, right? The cost of debt is also taken to be constant. And why the cost of debt is taken to be constant? Because ultimately we are not taking into consideration the financial mix or the capital structure of the organization. We're just taking into consideration of EBIT and the WACC. That's it. That's why the cost of debt is also assumed to be constant. The use of more and more debt in the capital structure increases the risk of the shareholders and thus results in the increase in the cost of equity capital KE. The increase in the cost of equity capital, which is represented by KE, is such as to completely offset the benefits of employing cheaper debt. So it basically means, see, we people just think that when the firm is increasing more and more debt or like taking like more and more debt for its corporation, only the cost of debt will increase and the cost of equity won't be affected. It's wrong. Ultimately, the cost of equity will also be impacted. Why? Because the risk of the firm is increasing. So the equity holders are also in a fear situation. उनको भी डर लग रहा है कि क्या पता कि फर्म बंद ना हो जाए. हमने जो पैसा लगाया है हमारा वो डूब ना जाए, बिकॉज अल्टीमेटली अगर फर्म अच्छा परफॉर्म नहीं कर रहा तो इक्विटी शेयर होल्डर्स की भी इन्वेस्टमेंट डूब जाएगी, राइट. एंड द फिफ्थ सेज कि देयर इज नो टैक्स, मतलब कोई टैक्स है ही नहीं फर्म में. See, like these were the approaches, be it your net income approach or net operating income approach. Like these were made by different persons and they had their own assumptions. That might not stand true in the present life because ultimately we know that the capital structure affects the firm. Simply on the basis of the EBIT, you cannot calculate or cannot assume the value of the firm, right? You can assume it like when the firm is a loss-making firm, so that's a different scenario. Like उसके बाद हम कभी like बाद में करेंगे. But capital structure देखना बहुत important है, business risk देखना बहुत important है. You also need to see about the tax. Tax हमेशा हो ही सकता है, ऐसी कौन सी कंपनी है जो टैक्स पे नहीं करती. There are certain things of tax evasion and all, like keeping that thing constant once again. But tax is something which is universal and you have to pay. Okay. Now, according to this method, the formula of the value of the firm is nothing but your EBIT divided by the cost of capital. Here your, okay. And if you just want to calculate the equity value, it comes out to be a value of the firm minus debt, and that we all know. Cost of equity can be calculated as what? Your EBIT minus interest. Why? Because when you subtract the interest component from EBIT, the only thing that you're left with the money available to the shareholders divided by your value of the firm minus debt component. But जब value of the firm में से जब debt component minus कर दोगे, the only component that would be left would be your equity. So ultimately the formula comes out to be your PAT by equity, like the same as we did previously. Okay. So that's it when we talk about the net operating income approach. And your net operating income approach is different from the net income approach. Okay. That is the thing you need to look upon. देखो यहाँ पे like they've given the formula also. The value of equity is equal to value of the firm minus value of debt. जब तुम एक बहुत एडवांस अप्रोचेस पढ़ोगे ना, I told you कि एंटरप्राइज वैल्यू का फॉर्मूला क्या है, इक्विटी प्लस डेट, माइनॉरिटी इंटरेस्ट को भी अभी भूल जाओ, माइनस कैश. तो अगर इक्विटी की वैल्यू निकालनी होगी इट वुड बी एंटरप्राइज वैल्यू माइनस डेट प्लस कैश. तो यहाँ पर एक कैश कंपोनेंट भी आना चाहिए, लाइक इफ यू लाइक digging deep and calculating the enterprise value के basis पे. And that's what the financial analysts and investment bankers do, they add back the cash also, because cash is very important and you should never ignore cash. Okay. These are the two approaches, like when we talk about the capital structure theories. The third approach we talk about is the traditional approach. Yeah, have your traditional approach. So what is happening in the traditional approach? It is the very simplest approach. And see, like when we talk about the net income approach and the net operating income approach, those approaches were called the relevant approaches. Were called as the relevant approaches. जब हम ट्रेडिशनल अप्रोच हमारी ये हो गई एज द जूम when you talk about your traditional approaches and this is your and the approach like which we'll talk about later. These approaches are called irrelevant approaches. इनको हम irrelevant approaches बोलते हैं. ठीक है. It doesn't mean कि ये like बेकार approaches हैं, but it means कि capital structure की importance यहाँ पे कम है या नहीं है. So coming back to the traditional approach, questions are like rarely asked on this traditional approach because the traditional approach says just one line. It tells you about the optimal capital structure कि firm का optimal capital structure कब हो सकता है. And we know that when the capital structure of the firm is said to be optimal. The capital structure of the firm is said to be optimal when the value of the firm is maximum and the weighted average cost of capital is minimum. That is the optimal capital structure the traditional approach focuses upon. Let's try to read the assumptions. It says, as per the traditional approach, the firm should make a judicial use of both debt and equity to achieve a capital structure. मतलब अच्छे से इनका यूज करो, एक अच्छा कैपिटल स्ट्रक्चर बनाओ, which may be called as an optimal capital structure. At this capital structure, the overall cost of capital back of the firm will be minimum and the value of the firm will be maximum. Back of the firm will be minimum and the value of the firm will be maximum. Okay. That is like when you talk about this optimal capital structure in the traditional approach. That's it. That is what we talk about the traditional approach. The last and like one of the important irrelevant approaches which are asked in the exam are your Modi-Miglani, the Modi-Glani-Miller model. This is also called your model. This is also called your model. Like two persons were there here, like Modi-Glani and Miller, and they framed their model and they came up with certain assumptions regarding the same. So they said the capital structure is irrelevant basically. Though in traditional approach, we cannot ideally say that that's an irrelevant approach basically because there the person is saying that you have to use a judicious combination of equity and debt to have an optimal capital structure which implies higher the value and lower the WACC. Okay. But जब मोदी मिगलानी मिलर की हम बात कर रहे हैं, it says that the capital structure is irrelevant and optimal capital structure हो ही नहीं सकता. This person says that the capital structure is irrelevant and there cannot be an optimal capital structure. Okay, ये assumption याद रखना because 3 to 4 mark question comes on explaining this approach. In your BBA exam, BCom exams, MBA में शायद कम आया because the MBA is like focusing more towards the numerical and practical concepts. BBA in finance है या मान लो कि BMS है तो वहाँ पे like they can ask you this. ठीक है. So going back to this, the present section examines the Modigliani's Miller model MM. So now I'll be using MM in short. ठीक है, तो समझ जाना कि I'm talking about this Modigliani Miller, which was presented in 1958 on the relationship between the leverage, cost of capital, and the value of the firm. इतना पुराना मॉडल है. Do you really think it might hold true in the present scenario as well? Absolutely not. They have maintained that under a given set of assumptions, the capital structure and its composition has no effect on the value of the firm. बोल रहा है capital structure and its composition basically, irrespective of the fact that how much equity is there in the capital structure or how much debt is there in the capital structure, it does not affect the value of the firm. That's it. The MM model shows that the financial leverage does not matter and the cost of capital and the value of the firm are independent of the capital structure. So it is basically saying the financial leverage, it means ultimately debt or the cost of capital, it does not matter. Matter ही नहीं करता, cost of debt हो, cost of equity को, उनका like submission करके cost of capital हो, nothing matters and they are independent of the capital structure. Okay. There is nothing which can be called as an optimal capital structure. They have in fact restated the NOI approach and have added to this leave that. हाँ, so basically it says कि optimal capital structure हो ही नहीं सकता किसी firm में. But also like ये बात MM model की मैं बोलूँगा कहीं हद तक सही है, because ऐसा कोई भी firm नहीं worldwide which will have an optimal capital structure. There are some problems with equity, there are some problems with debt, and no one can ideally predict how much equity and debt to take. Okay. Now it says like these are like some of the assumptions, and most of the assumptions don't hold true in the present life. The first assumption, it says the capital markets are perfect and complete information is available to all the investors free of cost. By capital markets being perfect, it means all the information is available to the investors, all the public information and the private information. Public information कहीं हद तक होती है लोगों के पास, but private information we as a retail individual investors do not have. So that is something which is not present in the like in the present scenario, and that is available free of cost. The public information is available free of cost, but for private information you might have to pay some money. So in real life it might not stand true. The implication of this assumption is that the investors can borrow and lend funds at the same rate and can move quickly from one security to another without incurring any transaction costs. So it is basically saying you can borrow and lend at the same rate. How can anyone borrow and lend at the same rate? Let me give you the example of bank. Do the banks borrow at the same rate and give us the loan at the same rate? No. If they're giving us, the bank would go down, the bank would be shut. The bank take the loan at a lower rate of interest and lend us at a higher rate of interest to make a profit. And that profit is nothing but your spread. It's also called an interest margin. Right? And also it says that you can quickly shift from your one security to another without incurring any transaction cost. There are transaction costs when you're buying the shares, like even on Zerodha, Upstox, Grow app, like wherever you want. ठीक है, जहां पर भी तुम बाय कर रहे हो, there would be some security transaction tax of like 0.01% or like 0.01% for commodity transaction tax, as we call them as the STT and CTT. कुछ ना कुछ transaction लगेगा, चाहे वो 0.1% भी क्यों ना लगे. So this assumption also does not stand true in the present scenario. Okay. The third assumption is say the securities are infinitely divisible. How can the securities be divided? Like for example, if you want to buy the share of TCS, and just assume that the price of TCS is going around like 3,700. Okay, the price might be different presently, but I'm just taking a random number. Like 3,700 का TCS का price चल रहा है. You have to buy one full share of TCS. In mutual funds, you people can buy the units of shares. But अगर तुम individual securities खरीद रहे हो, that one full share you have to buy. You cannot just buy मतलब कि like 1/4 of the share, or half of the share, or 2/3 of the share. That is present only in the US market where you can buy a fraction of shares. So maybe all these assumptions were made by the US people. तो इसलिए ये assumption आ गई. Even the cryptocurrencies like you people can buy, even 0.001% of crypto you people can buy. Third point, it says इंडिया में तो ये नहीं है अभी तक. Investors are rational and well informed about the risk return of all securities. It means all the investors know that how much return they want to get from the securities and how much risk they are taking to get that return. But in the present scenario, you cannot predict the precise amount of return that you're going to get and how much risk that you are taking. You can quantify it, but you cannot quantify it to a very exact number. The actual values might differ. The return might be higher than your expectations. It can be lower than your expectations also. Okay. Then it says all the investors have the same probability distribution about the expected future earnings. It means they have homogeneous expectations. Matlab, if I am expecting that I would be getting 12% return from the market after 5 years from now, my friend would also be expecting that he would be getting 12% return. If I am expecting that I would be getting 30% return from the market overall from all the investments, my friend would also be expecting that he would get 30% return from all the investments overall. His family members would be expecting the same. My friends, family, brother, sister, mother, daughter, son, chacha, chachi, everyone would be like expecting the same thing. But that is not possible in the real life. Everyone has different assumptions about the market and different expectations of the return on the basis of their analysis. Even the financial analysts of different companies do not agree upon their assumptions with each other. There is no corporate tax. How can there be no corporate tax? Okay, in the present scenario, there is corporate tax. Okay, that is something you should know upon as well, right? Then the personal leverage and the corporate leverage are perfect substitute. It says if you are taking a personal loan or your company is taking a loan, like both of them will get at the same rate of interest. It's not possible. The company might have a higher risk appetite. The company might have more assets as compared to your assets. The company might be given loan at a lower rate of interest, and you might be given loan at a higher rate of interest because you might have less assets and you are in a more risky position. Okay, so that is something you need to understand also. Basically, in the real life, they cannot be substituted with one another. Now, on the basis of these assumptions, it means the total value of the firm is equal to the capitalized value of the operating earnings of the firm. Matlab, the value of the firm is basically be computed on the basis of the operating earnings of the firm because it says that the capital structure is irrelevant. The capitalization is to be made at the risk appropriate, the risk class of the firm. मतलब एक रिस्क रेट हम ऐसा लेंगे फर्म की रिस्कीनेस को देखकर. The total value of the firm is independent of the financing mix, that is the financial leverage. Because ultimately the assumption, like one of the assumption as we talked about, it takes into consideration कि financial leverage है ही नहीं firm में, capital structure से कुछ फर्क ही नहीं पड़ता. So that is why the value of the firm is independent of that. The cutoff rate of the investment decision of the firm depends upon the risk class to which the firm belongs. बिकॉज अल्टीमेटली जो भी रेट ऑफ इंटरेस्ट हमें इन्वेस्टमेंट में मिल रहा है वो फर्म की रिस्कीनेस पे है. ठीक है, विच इज नॉट अफेक्टेड बाय द फाइनेंसिंग पैटर्न. तो हो सकता है कि बाकी मतलब कि बाकी चीजों से द रिस्क पैटर्न माइट बी इम्पैक्टेड, राइट? So these things can also be taken into consideration. Now, MM model में see now यहाँ पे they have told like some of the drawbacks. The drawbacks are told that non substitutability of the personal and corporate leverage. How can you substitute both of them? And these are some drawbacks that they have mentioned. Critical evaluation of the MM model. Transaction cost. They have said कि transaction cost तो होंगी ही होंगी. अगर आप शेयर्स में ट्रेड कर रहे हो, शेयर्स को बेच रहे हो, खरीद रहे हो, कुछ भी कर रहे हो, there would be some minimal average transaction cost that you have to bear, and obviously tax भी तो pay करना पड़ेगा. Like if you are holding the shares for more than 1 year, equity mutual fund भी hold कर रहे हो, तो अगर आपका gain is more than 1 lakh, you have to pay 10% tax. And if you're like selling it 15, अगर selling it तुम कर रहे हो like before 1 year, then you have to pay a 15% tax. बट इन केस ऑफ डेट म्यूचुअल फंड्स में 3 साल का लॉक इन पीरियड होता है. अगर तुम 3 साल बाद सेल कर रहे हो then 10% without indexation, or 20% with indexation. And what is indexation? It takes into impact the cost of inflation, and that we'll talk about in some other session, like how to calculate the cost of indexation and all that. And अगर डेट म्यूचुअल फंड को 3 साल से पहले सेल कर रहे हो, then as per your tax slab. So all these things that they have talked about, and these assumptions might not stand true in the real life or in the present day scenario. Okay. So that's all for today. We try to understand the three most important models of the capital structure, starting from the net income approach, in which it talks about the inverse relationship between the value of the firm and the weighted average cost of capital, because ultimately it says that the value of the firm is being affected by the capital structure. The second model that we talked about was a net operating income approach, in which we tried to talk about the capital structure plays no role, just your EBIT and your weighted average cost of capital plays the role in computation of the market value of the firm. Then we talked about the traditional approach, which says that the firm must have an optimal capital structure in which the value of the firm is maximum and the WACC is minimum. And the fourth one was the irrelevant theory, the Modigliani-Miller model, or the MM model, which says that the firm cannot have a capital structure, optimal capital structure ever. So these are the 3-4 models which you need to understand to the core. So that's all for today. I'll see you in the next